Good morning, everyone. My name is Christen Morand. As you can see, I'm with the forensics practice at EY. So I'll be moderating this awesome panel. We're really excited to get into some of these. You know, I'm the accountant in the room, so I can say like the very nerdy details of the specific accounting definitions and the pricing mechanism within the purchase agreement. And so the place I kind of live in professionally, when you see the definition of the independent accountant or the neutral accountant or the whatever the accountant, roulette term is on the purchase agreement, that if you ever make it to that point in the deal, you're going to get somebody like me or one of my colleagues at EY or any of our competitors serving in that role. So I regularly serve in that role or will support clients in that. So we'll be coming at the conversation from that perspective, and I have plenty of war stories if anybody wants to catch up with coffee later today. But I'll ask our panelists to let's go down the line, give a brief introduction of your role at your respective organization, your areas of focus, what's your deal volume like in terms of buy side and sell side, and your typical involvement, which will be, I think, helpful for the audience to understand as we go into this conversation.
Sure. So I'm John O'Brien. I'm responsible for corporate development at Brooks Automation. Brooks is a roughly $2 billion market cap company. We focus in two areas. One, semiconductor capital equipment. The other is life sciences, more specifically the storage and analysis of biological samples. My background, I was a tech banker for 8 years and started in corporate development at EMC. Was in that corporate development group for 2 years and joined Brooks in 2010 to lead corporate development. Corporate development at Brooks is acquisitions, divestitures, and strategic investments. We've done probably roughly 20 acquisitions since I've been there, half dozen or so divestitures, and a handful of strategic investments as well.
Good morning. My name is Mohit Singh, and I'm here from BP. I head our business development and our exploration teams. So business development, the way I look at it is, think of it as inorganic acquisitions. So whenever we need to add production or reserves, then we acquire it from somebody else. So that's the business development side of things. And exploration would be when we go out and find oil and gas on our own existing assets. So combined between those two, the intent is to replace the reserves that we are producing, get production up, get cash flow up. In terms of the deal volumes, the last big one we did was actually a fairly sizable one. So we just, end of October last year, we closed the $10.5 billion acquisition of BHP Petroleum's, all the US onshore assets. So some of the issues that were being discussed in the previous panel, and I'm sure on the upcoming panels, very, very recent, and in my memory at least, because we grappled with some of those same issues very, very recently. My background a little bit, so engineer by training, started off at Shell, then went off and did investment banking, was at Goldman for about 7 years, did a brief stint at RBC, and then came over to BP after that. I've run business units for BP, so I have been on the operating side, and then have, in terms of the engagement itself, I mean, day to day, I have project managers who are leading and quarterbacking each one of the deals. And my job is to more manage up dip and make sure that the board is apprised of what we're doing and what the risks are and where the exposure might be.
My name is Jelena Guzenko, and I'm with Siemens Corporation, with the M&A Americas team. I've been with Siemens for 17 years and with M&A department for the last 7. I lead M&A transactions for all operating companies and all strategic companies of Siemens aside of Siemens Healthineers. They are now being managed separately. I'm also the head of carve-outs for the Americas region. We are very highly active in the M&A space on both sell and buy side. We have 3 major M&A departments. One is in our headquarters in Munich. The other one is in New York City, and I'm part of this group. And also the other one in Beijing. Hopefully Siemens is well known. We are currently organized in smart infrastructure and digital industries in gas and power. And we just actually announced that we will be spinning off gas and power in 2020. And we also have 3 strategic companies, Siemens Gamesa, Siemens Healthineers, and Siemens Mobility.
Awesome, thank you all.
If you're interested in additional information on innovation and M&A, I encourage you to check out the Transaction Advisors Institute, which is a robust source for knowledge on M&A best practice.
We host a series of M&A conferences, run an elite M&A academy, offer M&A masterclasses, conduct M&A research, organize the M&A Leadership Council, and publish a prestigious M&A journal.
Members of the Transaction Advisors Institute include corporate executives, board members, and private equity investors that are interested in understanding the critical issues impacting transaction planning, structuring, and execution.
I encourage you to get more involved in the Institute.
So we're going to jump into some of these mechanisms. A lot of people are probably pretty familiar with a working capital mechanism. I'm hoping that we'll have enough time to touch on the locked box mechanism as well. And I know, Jelena, you've got a little more experience on that. But let's start with earnouts, because to me, we'll get some arm wrestling maybe up here in terms of how much you like using them, or what are some tips and tricks to help them be successful. I think there's a big joke around the water cooler that you either love them or you hate them, and I know we have a couple varying opinions on this on this topic. So Mohit, let's start with you, because I know you said you've had some pretty decent success in using them. But how can you make an earnout successful? What are some of your best practices as you think about how you're going to structure that earnout?
That's a great question. So for us in the energy space, the commodity price is the biggest and most sensitive independent variable, right? So if oil price goes up by $5, your asset value could go up a few $1 billion or down a few $1 billion. The same thing on the gas price. So you have two kind of very sensitive independent variables. One is the gas price, one is the oil price. And historically, sometimes they used to trend together, but in the recent times, we've seen the decoupling of the two prices. So what it essentially does is almost earnouts used to be in one dimension. Now we have to kind of think of it in two dimensions, so it makes it a little bit more complicated. The challenge with that is, a buyer comes in, they run their analysis, and they do their valuation, and depending on whatever their view on the prices is, will lead to a certain bid value. The ask for us, as if we are the seller, is we are running based on our whole value is being estimated on what our view on the go-forward prices are. And of course, out in the market, there's a view, because the strip is out there, which is telling you what the futures market is indicating. So you have all these, call it multiple different views, and the investment banks research firms will come out with their own view, and there will be a consensus view. And depending on which one of these price decks you run, you come out with vastly different values, right? And in certain instances, they can be off by an order of magnitude. So then when you have that big bid-ask spread, what we have found success with is, okay, we recognize that the commodity price that you're putting in or plugging into your model is what's driving this big disparity in the valuation. Why don't we do this? At closing, you deliver to me a certain price, and then going forward every year, let's say if a benchmark price, let's say, so for gas, it'd be the Henry Hub, or WTI for oil. If it stays above a certain pre-agreed threshold, then you pay me an incremental, another contingent payment, right? So what it does is, it helps bridge the gap between the bid and ask, which is very, very important to consummate a deal. And the good news is, in the energy space, there's at least the folks who are very seasoned in doing deals, they've had lots of experience with putting these kind of contingent payment structures together. The challenge is, what's the term, how far out in the future they go out, and what's the pre-agreed formula. And what I've found is the simple is better. When you start putting more bells and whistles into it, it becomes more complicated, A, to administer it, and B, even to kind of track it over time. The challenge is, what's the headline price that you announce when the deal is being announced, and then how do you, because the buyer will position it one way, that I only paid this, and I got this, but the seller will say, oh, they actually paid us this because I'm actually going to make all of this. So there's a little bit of balancing of the PR angle that also goes on.
When you think about the timing, then, do you often prefer to have your earnouts just for a year, for 2 years? How far out do you like to go?
I've seen as much as 10 years, and I don't like those because 10 years is a lifetime. Management changes, and even when you think of the life or the cycle of commodity prices, highs and lows, 10 years is a very, very long time. You might see multiple cycles going through it. So the preference is, 2 to 3 years, because but then again, that's subject to negotiation and both sides agreeing to it.
Sure. Jelena, what's been your experience with earnouts, and how do you like to protect yourself and make sure that it's really going to operate the way both parties are wanting it to operate?
Sure. Well, at some point, we actually really liked earnouts, and then we stayed away from earnouts because it was additional complexity. And lately, we embraced earnouts again. And that's predominantly because we are also focusing on digitalization investment field. So a lot of the times, we would be going after a startup phase companies, and we would see lots of hockey stick revenue developments. And we would have questions whether or not the technology milestones will be realized or any other regulatory approvals, and also whether or not the entrepreneurs would like to stay with the company once they become a part of Siemens. So we found that it would be actually a very good construct to introduce the earnout to bridge the valuation gap and also to incentivize the sellers to perform. And that has been very successful for us. What was important was, to think about various scenarios, obviously, beforehand. First of all, what are we going to do with the company post-close? Is it going to be mainly left standalone, or is it going to be immediately integrated? You have to think about this future scenario and also try to word the earnout as precise as possible, because if you leave interpretation room for later on, that's the opportunity to capitalize on, and it's an opportunity for future disputes. So usually we try to keep our earnouts as precise as possible, as short as possible. They probably would be tied to the revenue component, and again, the milestones that can be achieved and employee retention. We don't like them to go over 3 years. Actually, they usually never go. So I guess the sweet spot would be around 2-year time. Again, the earnouts for us work probably best when the company is left as a standalone entity as part of Siemens, because then you can also monitor it in a better way, and there is less of an argument from the sellers that they were distracted by the integration activities, for example, or otherwise could not realize the earnout potential because of being embedded in Siemens.
Yeah, so when you're structuring that and you're sticking with thinking about the income statement higher up there with the revenue line item versus going down to EBITDA or something like that, how are you going to define, how do you guys like to define revenue? Do you tie it to the revenue item right directly off of an audited financial statement? Do you tie it specifically to US GAAP? Is there would you be even more specific than that in terms of measuring the revenue?
Mm-hmm. Well, okay, we are actually a European listed company, so our internal reporting structure is in IFRS and SFRG actually, which is just the Siemens financial guidance on how to use IFRS. When we would be acquiring a company, let's say, that is following the GAAP rules, externally we would be dealing with them in their accounting principles. If we are doing our internal analysis, then obviously we might as well translate it to our accounting principles. But again, the dealing would be based on what the company is using for their reporting structure. What's important is to make sure that you have a clear calculation, and yes, usually it's revenue-based, and that the same principles are being sustained for the calculation later on. Mm-hmm. So there would be a schedule that would be showing on how the calculation will be done. Maybe another point to think about is while a lot of the times the revenue component would be a part of the earnout, you also would like to sometimes put a provision around the average cost structure. So, for example, you don't want to motivate the seller to go off and meet the revenue requirements, but selling products and services to a much lower prices, so which would be hurting the margin of the company, and at the same time, the revenue component would be realized from the earnout perspective.
Absolutely, yeah. I've got a few war stories on that. The cost definition, because it can be very nuanced, and we had a pretty significant dispute where it actually came down to the word "and" versus "or" in the way that the cost piece of the earnout was defined. It was to take top-line revenue minus a contractually defined term of direct variable costs. And the definition was costs that vary based on units manufactured or sold. And so I think the intention there was really to have "and," but because it was the word "or," we were effectively the calculation called for you to effectively reduce your revenue by your cost of goods sold, right? That's your units manufactured, or that's your units sold, but the units manufactured piece was effectively your inventory cost. So you had a situation where a buyer takes control and they're ramping up all this inventory and able to reduce revenue by that cost, which absolutely was not the intent of the parties and truly came down to that one little word. And so when you hear many of us, on the previous panel today and, with us here and in the future, the words really do matter. And it can, in that case, for us, it came down to an "and" versus an "or." And as the accountant trying to, interpret that and apply that properly in the context of the contractually driven calculation, it can certainly be frustrating for a lot of parties who, as you're reading that draft, leading up until signing, and you've read that definition however many times, you kind of skim over those words. So John, what's been your experience with earnouts? Do you have a love-hate relationship with them? Or,
Yeah, so we've entertained earnouts 3 different times. So first of all, my CEO loves the idea. I'll come back to them. We bid X, they want Y. Let's do an earnout. So it's a great way to bridge value gap for sure. But so we've had 2 deals that died during the earnout negotiation, and then one where we were able to just agree to a fixed price after trying to slog out a definition of an earnout. The key thing that breaks down for us is, we integrate these businesses after we acquire them, and an earnout requires some level of autonomy or at least being able to ring fence the entity. Even at a top line level, we don't want to pay the target for revenue that they're generating because of our go-to-market. So even at a top line, it's really hard to define what they should get credit for post-close from a revenue perspective. So that's the biggest challenge for us. The second challenge is, depending on, the first thing that our CEO will say after he suggests the earnout is, we should tie it to making sure that person sticks around. And that can potentially trigger different accounting for the purchase price as compensation for that, because of that clause. So that's another complicating factor with the earnout that has caused us to stumble. So I don't hate the idea of an earnout. We just haven't been successful in doing one.
Yeah, that's fair. And I think that ringed fencing point is a particularly interesting one. So when you guys, I'll turn it to the other side of this little table that we have, and those, the 2 of you that have had a little more success in using them, how do you keep that fence around what you're actually measuring? Are you being very specific when you define maybe the word company within the purchase agreement? Are you putting the specificity or the definition of what you're measuring more on the measurement piece, the commodity price or the revenue, or how are you making sure that the population of what you're measuring is the right population?
Happy to go first. And
Sure.
The success we have had is more around when we're doing an asset transaction, right? So what it means is, if I'm, let's say, getting out of a basin, which is an oil and gas producing basin, and I'm conveying that asset to a buyer, then I'll say, I'm completely out of that basin. So it's a clean exit for me. It's a complete exit. So there's zero interference, which is the point you were making. So it's it's easy for me to monitor the performance of it. And it goes back to my earlier point about it has to be simple. So when I'm looking at a benchmark pricing, we are price takers in our business, right? We don't set the benchmark prices. And there's zero chance of anybody unduly being able to influence what the price is at a benchmark. It kind of depends on supply, demand, and storage levels. So both from a buyer's point of view and a seller's point of view, that's why we have kind of zeroed in on benchmark prices as our go-to mechanism, because after a lot of hits and trials, and that just works for both sides because it's truly, I would say, independent. That's thing one. The other one where we've had success is in our oil and gas business, you're obviously drilling wells to produce oil and gas. The earnouts are related to when I was selling it, let's say the production was from these two zones, and there is an additional zone which is a shallower zone, or there might be a deeper zone, which I haven't produced from. But the moment you, the buyer, produce anything from these new zones, you pay me some value for these zones, because when you were acquiring it, you didn't allocate any value to these additional zones. And I get it because we didn't produce from it as a seller. But the moment you perforate in that zone and start producing from it, or you land a horizontal in that zone, that's when you're telling me that it was valuable to you. So that's the triggering mechanism that whenever you go out and then we come up with a formula on what's how many number of wells, and what the formula is. Okay, when you drill X number of wells, you pay me Y dollars for it. So, and that's been fairly successful too, because it goes back to, again, the point I made earlier, which is simple, very easy to track and monitor. The challenges that you were describing earlier, I mean, those are, to me, more in a corporate kind of a deal where when you're combining the financials, because in what I'm describing, it works really well in the asset transactions where it's just very arm's length.
Yeah, that makes sense. I like it.
For us, I guess, if you think what would be the easiest way of doing it would be just to integrate the company as a separate legal entity and keep it that way for some time. If there is earnout structure to it, but otherwise, if it's again pegged on certain regulatory requirements, it's actually pretty clear on how we're going to measure it. If it's pegged to the revenue development, well, usually there are products and services, they have also clear depth structures to them, or cost centers, and so on. I mean, if you think about it also, I think actually you brought this point earlier, a lot of the times you acquire a company and then all of a sudden it benefits from economies of scale and scope, and in a way you're giving away those synergies to the sellers. Having said that, we actually like to pay out our earnouts, because at the end of the day, if we do, that means that the transaction goals, which were worded usually realistically, optimistically, have been realized, and so we like doing that.
Yeah, no, that's helpful. So I think, in the interest of time, we'll switch gears a little bit and turn the page over to the working capital mechanism. And I would imagine many in the room have experience and often will use that mechanism in a deal. Thinking about it from an accounting perspective, I can absolutely talk you through every balance sheet item and where the disputes often come up, or where the areas of contention will sometimes be in that calculation. But when the three of you think about your use in the working capital mechanism in your respective organizations, what have been particularly challenging or pain points for you as you guys are working through how you're going to define that and how you're going to use it going forward as the deal closes? John, let's start with you. Maybe we can go down the line.
Sure. So I'm fortunate in that our board and our CEO gives me a lot of latitude when it comes to the working capital mechanism. And so we get creative oftentimes if we run into challenges during diligence and how we define working capital and how we set pegs. I'll say right up front, when we're in negotiation of an LOI, targets will often request the working capital mechanism to be defined at that time. And I've been successful, I think, 100% of the time saying two things. First, I'll say, I can't do it now. I want to do it after we do the diligence on the balance sheet, number one. And then number two, I've never had a deal break down because of the working capital mechanism. And so that usually gets the target comfortable. And so that's sort of how we approach it.
Yeah.
So that's.
I think, again, in oil and gas, I would echo the sentiments you just expressed. It's fairly well established, the protocol and how working capital will be defined. I think wherever we have had problems is where the definitions are not crystal clear, right? Okay, what accounts for, what goes into what cost center, what is to be adjusted for and what's not to be adjusted for. The one where we've found some disagreements at time is, in my business, a big part of the inventory is actually sitting in the tanks, right? So you have wells out there. There might be thousands of pads where you have a whole battery of tanks, and that's where the oil is sitting. And how good is that measurement of how much oil is in that tank? And it's a very distributed problem because you have to agree upon how much is there, and how do we eventually, when the buyer takes control of it, then when they are going to go measure, if they find some discrepancies, for example, then what is the adjusting mechanism? And the good news is that, deals have happened for hundreds of years, and there's pre-established, and for the seasoned deal makers, there's, it's almost like a template. You slide it into your PSA, and both sides discuss it. And we tend to spend more of our time and do more brain damage on certain other things. Working capital, I find, not to dismiss it, but it's been one where there's very well-established protocols.
Will you ever do an inventory count in conjunction with close?
Yes, absolutely, yes. So the inventory, so tank battery is one. The other big one is imbalances, which is, and I'm getting into the minutia here, but as a producer, the custody for the molecule transfers over to the midstream company at the lease line. So let's say this is where the lease line ends, and that's where they have a meter. And so that's where the midstream company is taking custody of the molecules, and I might have a meter ahead of it, or before it, where I'm metering it. So I might measure X, they might measure Y, and you'd be amazed how often X and Y don't match. And
I don't know if we really would be amazed. As an accountant, I wouldn't be amazed.
I hate it when they don't match, because they should match. Every molecule should be tracked, and but it's amazing how, the pressure changed, and yes, pressure changes, so it expands. And most of these meters, as you can imagine, they're volumetrically measuring, whereas what you're trying to measure is the mass of what you are getting paid for.
Right.
And again, I'm getting into the minutia of it, but those are kinds of things that, so the pipe imbalances are a big part of the adjustment. And the unfortunate problem with that is, there's a lag to it. So you're selling it today, but the pipeline company may not adjust for it 3-4 months down the road. So how do you account for that time lag? Mm-hmm. And some of these movements can be fairly sizable depending on how much oil and gas you were producing.
Yeah.
But again, the good news is there are pre-established templates that folks kind of agree to, and then it's more a matter of, does this work? And both sides, yeah, we need to tweak this, and then you just slide it into your PSA.
Yeah. Jelena, how about you?
So we use working capital adjustment on most of our Americas deals. It's just widely understood and accepted, and we like to do them, especially on smaller deals. Now, our headquarters counterparts or European counterparts a lot of the times prefer Lockbox mechanism, and also ask us to use it as well, especially on the deals that span over multiple countries, jurisdictions. Generally, we have our due diligence team set up very early on, up to 21 different work streams. And we have our internal accountants and external accountants, workstream finance as well. And we scrutinize, of course, the financials of the target very early on. What's important is to determine what would be that acceptable working capital level at closing, and it sometimes takes some time to review all of those historic financials and to agree with the sellers on what that threshold might be. So, which is a step that you can actually skip when you use the locked box mechanism. So But again, in fact, I'm more familiar with the working capital adjustment mechanism because this is what we do here.
So when you guys slot in, Mohit, you talked about just having like a template that you'll slot in, and that gives me angst sometimes just because I know if you don't take the next step of scrutinizing if this actually makes sense, that's when the problems come up, right? Absolutely. So when you guys think about what you like when you think about that template and how you slot it in, do you have an example calculation as an appendix? If so, what level of specificity are you including in that example? Is it an illustrative calculation? Are you getting down to the GL account level? Are you using the most recent audited balance sheet or perhaps the most recent unaudited balance sheet as as just example numbers in there? Talk to us about that example or how you're really defining it physically in the back, in the back of that schedule.
Yeah, so that's a good question. Whenever we have audited financials available, what we tend to do is, so the most recent transaction that I was mentioning, so we actually did hire E&Y, and E&Y came in and they went through line by line on the working capital and what adjustments need to be made. And so the deal team was sitting at the deal negotiation table where the PSA terms are being negotiated. We had a sidebar group that was just agreeing on the language for working capital, to your point.
Yep.
In that one, unfortunately, we did not have audited financials. They had unaudited financials, which again require, as you're indicating, a little bit more closer due diligence. And so that's why we went through line by line. So our accounting folks sat down with the other side's accounting folks, and then also E&Y was in the mix from our side. And just, okay, explain to me how you're allocating these costs and how they roll up and which line item are they being rolled up into, and should this be adjusted by this mechanism or should I be capturing it some other way? Right. So yes, there are templates, but again, it's very situation dependent where, like in this situation, we ended up tweaking it quite a bit based on what we saw because you have to tailor it to the way the seller was accounting for different things. And the end goal is at the end of it, everything should roll up and everything should match, right? And which again, sounds, you're an accountant, you know sometimes things don't match, and that's when the disagreements come in and how do you adjust for it. And so you'll have your closing, you'll have your settlement statement, then you'll have another settlement. I mean, so for us, when we do a transaction, it may take us another 2-3 years to have the final settlement statement because some of these adjustments do take time and back and forth.
Yeah, that's
right. Yeah, I'll maybe pause there.
Go ahead.
I just think that example schedule is really important because for two reasons. One, it helps you finalize the definition because it'll help you sort of surface some issues you might have with your definition, and then secondly, it provides a roadmap for the people who are dealing with a post-close, which I only get involved post-close if there's an issue, and so usually that's a helpful roadmap for the people who are doing the work post-close.
Yeah. How often do you guys make a defined term of like accounting principles where, sometimes you'll define accounting principles as like, it's, seller's historical practices or GAAP. It might be one of those over the other, and then you've kind of tiered it as like, there's this first tier, and if that's not applicable, you go to the next tier. How often are you defining accounting principles in that fashion? Or I guess the opposition of that would be to even more specificity in the schedule, your defined accounting principles are, for example, inventory, this is how you account for it. Accounts receivable, this is how you account for it. Reserves, this is how you account for it. What do you guys think about the way you're going to define those accounting principles? You want to start with first?
Yeah,
down?
I mean, we try to always use, first of all, our contract, which is a form from counsel, and that usually starts off with GAAP. But we'll be open. I mean, we acquire a lot of companies that are founder-owned, so they're cash accounting anyway, no GAAP financials ever. So we pretty quickly go to whatever their company policies are.
Got it.
Yeah, we've done it all across the spectrum. I mean, so again, BP, we are dual listed, so listed in London, so we follow IFRS. Our US entity, of course, follows GAAP. And then there are times when we acquired a company that follows GAAP, and other times we've acquired somebody that follows IFRS. So The good news is those are fairly well-established protocols, and so yes, in the documents we end up defining it as much as we can just to avoid any confusion down the road, because the thing that happens with us is it does take several years for us to truly consummate a transaction. And what we're trying to avoid is any ambiguity which might lead to, this is like you were talking about that incident of and versus or. I mean, that does come back and bite you at times. So we do spend a ton of time just making sure that we get the language right at the front end. And then also organizationally tapping into all the prior experience and expertise that we have, because there's folks who have been with the company 30, 35 years and they've done multiple transactions. And we value that input because they said, 20 years ago this happened and that's why we need to have this. Can you make sure that this language is in there? So that's on the internal side, and then also on the external side, I mean, we don't spare, resources in terms of engaging with the right advisors to make sure that we don't miss a trick anywhere.
Sure.
But again, it still does happen, but but to answer your fundamental question, yes, we try to define it as well as we can.
Yeah.
Agreed with what just has been said. Again, if it's an environment where we have very sophisticated buyer seller, then it's probably easier because their financials would be a lot of the times audited. If it's a small moms and pop shop, our internal accountants a lot of the times would be cleaning up their balance sheets, and it will be clearly defined in the schedule. And what you want to make sure is just that you are able to follow the same logic, whatever that was, and just compare apples to apples.
Sure. So I'll pull a little bit of an audible because I'm starting to see a little trend in this additional sentence, and I'm curious if any of you have seen this on any of the recent transactions that you've worked on. So, you typically have the structure that you've got your closing, your closing working capital, your closing balance sheet, and it's going to be prepared maybe 30 or 60 days post-close. It gets shared with the other side. They've got their review time, and you kind of just follow on down the line. But I've recently started to see more use of like a sentence shortly after where you've defined working capital and you've probably tied it to accounting principles, where it says like, I'm probably going to butcher the eloquence that an attorney would have actually drafted it, but something to the effect of, under notes, you cannot take into effect any facts, circumstances, changes in anything after closing. So when you think about it from an accounting perspective, I give the easy example of like you've got accounts receivable balances and one of the customers of the company files for bankruptcy, 15 days after closing. So that's a fact and circumstance that could potentially impact your as of balance sheet date, and you're aware of it before you're issuing your closing statement. So we would, as accountants, we would typically integrate that knowledge, just like you would in an audit, to apply it to apply it to that balance. But there's this kind of new trend I'm seeing where the language basically precludes you from doing that. So it's kind of this like mental shutoff right at closing of, you kind of put headphones on and you're in a vacuum, and anything that you learn after that point cannot be integrated into the calculation. Have any of you experienced or used something like that?
I haven't seen that yet, and I certainly hope I don't.
No,
I haven't seen that either. We have our treasury group go through the receivables and kind of just look at the counterparty risk from a credit point of view and
Sure.
and where the risk might be, and hasn't come across quite yet as where we had to do a special provision for anything like that. But we do spend the time just to make sure what the risk is.
Mm-hmm.
I haven't personally seen that either, but usually my involvement is between the transaction onset and closing, so maybe my post-closing colleagues have seen it, but haven't heard of it.
Yeah, has anyone in the audience, am I the only crazy one here? It's something I'm seeing a lot more, just honestly in the last about probably 3 or 4 months.
I've seen that tried recently, but I would highly recommend against it. I'm working on a post-acquisition working capital now where it's a little fraudulent, specifically in the content or the quality of a chemical in the inventory. So I think if you, with your example on AR, a bankruptcy probably makes sense. Why would I agree on that post, closing at the date of closing? But I'd be very careful on misrepresentation or potentially fraudulent although maybe not at the senior level, but at the local level of, is the content, nonconformity of the inventory correct? If you had that language, I think you would end up quickly in litigation, it would sound to me.
Well, that's why it comes to us. Yeah, but it's certainly something I don't love to see in a contract, and I absolutely advise clients not to. But it seems, at least in some competitive situations, I think it's language that I'm seeing. Sellers are probably really trying to force, like, they want their judgments and their historical approach to be used, and they don't, they're hesitant that the buyer could create something new that would apply to some of their balances, and it's an interesting thing, and it's popped up more frequently than I would have expected. So I was curious to get your perspective. And I mean, maybe that shifts us a little bit into the thoughts, to the point of there's a fraudulent situation going on. What other remedies are there available in the contract? We talked a little bit when we were preparing for this panel about, how we would then integrate reps and warranties or other areas of the contract beyond just the closing mechanism as sort of a protection either to the buyer or to the seller as you guys are structuring these. So maybe, Jelena, maybe we can start with you and comment towards this time on that.
Of course, reps and warranties, and we actually even lately started looking into reps and warranties insurances on the deals that maybe are especially risky or where the transaction speed is very high. Otherwise, we have great M&A lawyers who make sure that they de-risk the contract as much as possible.
I agree with that. So reps and warranties, very, very important. And then insurance, again, an important part of it. In certain instances, we even kind of think of some bonding requirements, see if there's that would help mitigate some of that exposure, especially if we see a big risk with certain aspects of the financials. And in our business, it comes down to one of the bigger ones is, let's say if you're acquiring an asset which has 10,000 wells, and regulatory point of view, you're required to go and plug and abandon those wells. And it costs you money to P&A those wells. And each well might be, let's say, $100,000 to plug and abandon. And you have to do it the right way because the regulatory bodies, I mean, that's kind of your license to operate, because you have to, whenever you're getting a permit to drill a well, you're committing to, once you're done producing, you will return the landscape and the subsurface back to the way you found it. And one of the challenges we have is, if you're selling it to a reputed buyer with a well-capitalized buyer, let's say, then you're comfortable with that liability being transferred over to the buyer because they will take care of it. But let's say if you're selling it to a smaller shop, which you don't have very much confidence in that they might just go under 2 years from now, then what happens to that liability? Does it come back to you? So we try to get some insurance there and some bonding requirements in those situations to just make sure, when we are selling it, it's a good clean break for us and it doesn't come back to us.
So in addition to reps and warranties and reps and warranty insurance, if it's a known item that you could probably see is covered by the general indemnification, we'll often create a specific indemnification for that item just to make it more clear for our team that we've identified it, that it's an issue, and then sometimes even a special escrow for that item as well. So that's another thing that we'll do as well.
Yeah.
Maybe also to add to it, I think the way we run the process, the due diligence process is also very important. So because we run lots of transactions and we have up to 21 different work streams and all the experts who are very much scrutinizing every target or prepare our target, we just try to make the due diligence as thorough as possible, and then we would be addressing specific issues contractually.
Christen, you had a question.
Oh, yeah, go ahead.
Thank you. Especially when you're buying a private company, in the net debt or the debt specifically, what do you include in that? Just the interest-bearing debt or the other debt too?
Yeah, so that's a good one. Yeah, I was going to mention that as well, but you could argue that's purchase price. But yeah, we'll after the accounts have done their work, they'll come to me with a laundry list of items that you could argue are debt-like instruments, and I'll review that with the accountants, and I'll say, well, that one seems like a little bit of a stretch, or this one seems like you can make an argument, and then I'll throw it into the definition of debt, and I'll warn the target ahead of time. I'm like, we're not touching the definition of debt until we're done our accounting work, and then we'll throw those items in, and you get a sense through negotiation of which ones were a little bit of a stretch, because sometimes the target will push back real hard, and other times they'll be like, yeah, I see your point. We could treat that as debt. That's an obligation that you're going to assume post-close. It's not necessarily on the balance sheet, but you're going to have to pay cash for that in the future. So that's how we treat it. Did I answer your question? Or?
Yeah, I mean, I think it's very deal specific.
Yeah.
There's not like a hard, fast rule of, okay, here's your list, right?
Yeah, I mean, the target will push for a very strict definition of just, as you said, interest-bearing instruments, but that's part of the negotiation for purchase price in my mind.
Mm-hmm. Yeah, well, with a few minutes left, I know we promised we'd touch on Lockbox for just a second, because I know, we're constantly thinking, think about the landscape of M&A, and a lot of companies are going into sort of like these new frontiers that haven't really been an area that they've been in before, maybe looking in new jurisdictions, new countries, new technologies, or things like that. I mean, you can, I love reading like our, the surveys that we do, like our capital confidence barometer, and looking at, where are people looking to get into, where are people looking to get out of, right? And the Lockbox mechanism is something that, it's very popular in Europe. It's used very regularly there. Jelena, I know you've mentioned you guys do a lot of deals there using the Lockbox. Have you seen any appetite for it in the United States? I know I'm getting like little percolations here and there, but maybe for those in the audience who have possibly entertained the idea, or they haven't had the experience, so they're a little more hesitant to use it. What's been your experience, at least in seeing it in the U.S., or maybe if not, you can comment on, maybe give some words of wisdom to the folks in the room that it's really not as scary as they think it may be, and it's a pretty clean mechanism and a very easy exit.
It works, but yes, there is not too much appetite that I personally experienced in the United States on our deals. When we would be introducing the concept to the other parties. So everybody knows working capital adjustment, and whenever you come up with Lockbox, usually there would be questions and whether this is the only way to do it. And then we have a lot of push from our headquarters on some of the deals to use it. It works well. You determine really the value of the company in advance. You isolate them financially, make sure that there are strong covenants in place, and that there are no leakages of the capital, and that the cash remains with the business. And the beauty of it is that at closing, there is really no working capital adjustment. Mm-hmm. And also there is no lengthy discussion on what that threshold is supposed to be at closing. So it works, from what I've been at least hearing is that the mechanism is gaining on popularity in the States as well.
It is. I see a lot more clients at least considering it now, whereas before they would have just completely turned the corner. Now, certainly in more competitive situations as well, where the seller can, in a way demand it a little bit more. Serious buyers are actually, they're thinking about it a lot more seriously and evaluating it. I mean, it changes the, in a way, it changes the approach to diligence just a bit, and you just really need to have all that comfort up front, right, and understanding what you're actually, as a buyer, what you're actually buying, and the working capital mechanism. I think it's just, in a way, almost feels like an insurance policy. As kind of like a backup that you can always fall back on working capital, right? But with a Lockbox, you can't do that. So I know we've got just a few more minutes, and I think I saw a question right over here.
Hi, Nicholas Boussier from Bungie. I have a question regarding the working capital. So, I feel like not enough time is spent on defining the reference working capital. Especially, we talked a lot about change. Some of the business sometimes that you're acquiring have gone through some level of structural change. looking at doing a look back for 12 or 24 months, simply doing an average sometimes is not accurate representation of what it's going to be going forward. Do you see a lot of adjustment or attempt to try to adjust, the reference to not just to take an average and capture things that have changed in the business or structural change that going forward will impact the level of working capital?
So you're talking about like when you're setting the peg, like the way
Yeah.
that you're going to go about setting the peg.
Yes.
Have any of you done something different than that?
Sure, absolutely. I mean, it's, we'll start with a proposed average if it looks like it's going to benefit us. But if a target then comes to us and says, listen, my business has changed dramatically, we think a more reasonable peg is the last 3 months average, or we'll listen to that, and most likely if we're in agreement, we'll go with that. So it doesn't have to be a 12-month average. It can be whatever makes sense based on the business.
When I talk with our diligence teams at EY that are doing that piece of it on the transaction, I'm seeing less and less of a 12-month these days. I mean, that's kind of, that's historically been the default, but in a lot of circumstances, it almost seems like the 3 or 6 month has become the new default. It depends on what you're buying, but yeah.
If it is 2 years or a year and a half, do you still agree to do a lockbox?
That's a long time.
That's a lot of time, yeah.
I think there's just a lot more, because when you think about the way the Lockbox works, so you've got the buyer taking over basically financial control of the organization before they're taking over legal control. So you have to anticipate what are those cash outflows going to be. That's the defined term, permitted leakage. And so I would imagine that both parties would have a difficult time agreeing to an exact amount of what is the permitted leakage during a 2-year time period.
Yeah. So
and it's often more months.
I understand. Just interested to know, in deciding on the lockbox, what period is your maximum period, especially if it's unknown, like if you need to get regulatory approval. You don't know. Sometimes, if in Eastern Europe, sometimes in Hungary or elsewhere, it could take a whole year. Mm-hmm. So you don't know. So from your experience, what is the maximum lockbox you have used, period? Like the period.
I would say for us it would be just, it would be counted in months, definitely not in years, that's for sure. It just creates also a lot of need of governing the covenants and just making sure that there are no abnormalities, leakages, and so on. So, but in general, this is also not the usual way that the transaction would take such a long time, I guess, up to closing, so where it would be taking years.
I was involved recently in a transaction that took 6 months, but it could have taken a whole year.
Yeah.
So we took a chance, and it worked. But I'm curious to know, just when you're negotiating, it's good to know what other people are doing.
Yeah, I usually see about, the aim is usually about 3. It will sometimes go to about the 6-month mark. I don't have personal experience seeing it beyond the 6-month mark. I don't know if you've seen more than 6 months. I mean, you want it to be in months, right?
I'm thinking of one transaction we've done once, and yes, the closing took longer, predominantly because of the IT integration. So I actually did go over 6 months, but yeah, it's not the usual.